Hi, this is Andrew Jordan with NodeWise CPA. Something I think confuses a lot of people is thinking that income tax preparation and planning are the same thing. They're not. Tax preparation is mostly backwards looking. It's taking what already happened and reporting it correctly on a tax return. Tax planning is really about thinking ahead instead of just reacting after the year is already over. Honestly, that's where a lot of the value comes from. We're sitting down with clients throughout the year, talking through decisions before they happen, not just reporting them after the fact. Sometimes that's relatively straightforward things. For example, is the business operating under the right entity structure? Is an S corporation still the right fit? Are they paying themselves the right salary as an S corporation owner? That last one alone can save thousands of dollars. We see business owners all the time overpaying themselves on payroll. The issue is that payroll is subject to employment taxes, which are 15.3%. So if someone is paying themselves $20,000 more in wages than they really need to, instead of taking distributions, that can easily cost around $3,000 a year in unnecessary employment taxes. Another example is home office planning. For S corporations, we may set up an accountable plan. For partnerships, we may structure unreimbursed partnership expenses correctly and even help make sure the operating agreement allows for it. That can allow business owners with qualifying home offices to deduct a portion of their rent or mortgage interest, utilities, insurance, internet, and all their other household expenses. Usually that's not some massive deduction like you see hyped up online sometimes, but sometimes it saves the client $1,000 or more per year, and over time those things add up. Honestly, that brings up another important point. There's so much tax misinformation online right now. Some of it's blatantly wrong, some of it's technically true, but presented in a very misleading way. And some of it is actually accurate, but it doesn't apply to that particular business owner's situation. That's one reason we've actually created video series on overhyped tax strategies and then some under the radar tax strategies. Because tax planning is rarely about finding one magic loophole. It's usually a bunch of smaller decisions stacking on top of each other over time. One example of that is depreciation planning. The new tax law brought back 100% bonus depreciation, which is fantastic in many situations. But there are also situations where we intentionally don't take bonus depreciation because Section 179 gives us more flexibility. With Section 179, we can choose exactly how much accelerated depreciation to take on an asset by asset basis. And that matters because sometimes the goal is not to make taxable income as low as possible this year. A lot of business owners assume lower taxable income always equals better tax planning. That's not necessarily true. For example, in many situations, you're better off making roughly $100,000 per year for 3 years than making almost nothing for 2 years and then $300,000 all at once in year three. So we may intentionally avoid driving taxable income too low because we want to harvest those lower 10 and 12% tax brackets instead of wasting them. That's the kind of nuance most business owners never hear about. And then there's exit planning, which is a huge area of tax planning that people wait too long to think about. If someone plans to sell their business in the next few years, decisions we make today can have a massive tax impact later. For example, if a business owner is likely to sell next year, we may not want to aggressively accelerate depreciation this year because some of that may simply be recaptured later when they're in a much higher tax bracket after the sale or in the year of the sale. The earlier we know the long-term goals, the better advice we can give. And that's really the heart of tax planning. It's not about chasing gimmicks. It's not about finding one weird trick from TikTok. And it's not about trying to get taxes to zero. It's about understanding where the business owner is today, where they're trying to go over the next 3 to 5 years, and helping them think through decisions before they happen.